What if the battle over America's future money system wasn't just about crypto, but about control? Behind the Genius Act, a bill that sounds like it belongs in a science lab, lies a deeper struggle, not between dollars and tokens, but between private innovation and government power. At the surface, it's stablecoin regulation. At the core, it may be the biggest fork in the road for how digital dollars evolve and who gets to control them. Today we break down why Circle, Coinbase, and even Ethereum developers are rallying behind this legislation, while critics fear it opens a backdoor to state surveillance. We'll explore the real business stakes behind this bill and how platforms like SoFi, Robinhood, and Coinbase are positioning themselves in the coming financial architecture shift. This is not financial advice. The Genius Act is a turning point for stablecoins and digital finance in the US. It may look like a consumer protection law, but it goes much deeper. It decides who can issue digital money, how it's regulated, and how private companies can be involved. The law says every stablecoin must be backed one-to-one with US dollars or treasuries. This makes digital dollars safer and more transparent. It also means stablecoins could be used more widely in shopping, online payments, and global trade. Monthly audits and bankruptcy protections put stablecoins on par with cash and banks. This creates legal clarity, which helps attract large institutions. The act lets not just banks, but also fintechs and big retailers issue stablecoins if they follow the rules. This could lead to a wave of branded coins, like Walmart Coin or Apple Dollar. These companies might build their own payment systems and avoid relying on banks or card networks. For investors, this is a major shift. Money services could move closer to consumers, while traditional banks risk falling behind. The Genius Act also helps the US dollar stay strong in the digital world. It gives the US a way to compete with China's digital yuan. If successful, it can protect Americans from inflation and boost US financial innovation. For long-term investors, this opens global growth opportunities in digital dollar platforms. But the law also creates complexity. If too many companies issue different stablecoins, it could confuse users. Without shared systems to connect them, the market may become fragmented. Investors should watch for whether companies like Coinbase or Circle can lead and unify the space. The law also affects how companies earn from stablecoin interest. Today's high interest rates mean stablecoin platforms earn strong yield on reserves. Coinbase's model shows how this can become a key revenue stream. But if rates fall, these profits could shrink fast. Investors must factor this into long-term value models. For banks, the act is both a threat and an opportunity. They could lose deposits to tech firms with better user experience. But if banks use blockchain and work with stablecoin issuers, they can open new revenue lines. Future winners will likely be those that form strong partnerships across tech, retail, and finance. In short, the Genius Act resets the foundation of U.S. digital money. It merges banking, tech, and payments into one regulated framework. Investors should track three things: how fast coins launch, how well systems connect, and how platforms turn flows into profit. This is a chance for the U.S. to lead in digital currency. The biggest winners will be the companies that build and control this new financial infrastructure. The Genius Act is built around Circle's USDC model. It mandates one-to-one backing with US dollars or treasuries, monthly audits, and public reserve disclosures, rules Circle already follows. This regulatory clarity gives Circle a first-mover advantage and institutional credibility. But the same rules lower entry barriers for big tech. If Apple, PayPal, or Meta issue their own stablecoins, Circle risks becoming a back-end utility with no user ownership. The threat is commoditization. Circle could be reduced to plumbing in value chain it once led. Its success now hinges on maintaining network effects, forging platform partnerships, and staying essential in high-throughput stablecoin settlements. Coinbase doesn't issue USDC, but it captures 100% of the interest income on all USDC held on its platform. In Q1 2025, stablecoin-related revenue grew over 50% year over year, now its second largest income stream after trading fees. This effectively turns Coinbase into a yield-generating digital bank, capitalizing on USDC balances in a 5% plus rate environment. The Genius Act enhances legal certainty and could help USDC take share from Tether, especially if US regulators tighten transparency rules. Coinbase is moving fast, already launching B2B payment products using USDC to challenge PayPal and Visa on speed and cost. If USDC adoption accelerates across e-commerce, Coinbase becomes core digital dollar infrastructure. But this model is highly sensitive to interest rate cuts. A Fed pivot could compress yield income and pressure margins. Investors must weigh long-term network expansion against short-term rate cycle risk. Robinhood is repositioning from a retail brokerage to a digital asset hub. It doesn't issue stablecoins, but monetizes user engagement, cash balances, and trading volume. In high-rate environment, idle user funds generate meaningful net interest income, sometimes rivaling trading revenues. This model mirrors Coinbase's USDC float strategy, but uses fiat and is more diversified. Robinhood is also expanding globally. Its acquisition of Bitstamp opens doors in Europe and Asia, extending wallet, trading, and payments capabilities across jurisdictions. With a young user base and strong brand affinity, Robinhood has the potential to become a retail-facing crypto super app. But its earnings remain highly volatile, tied to crypto trading activity. Any drop in active users or volumes hits top-line growth immediately. Its political proximity may offer regulatory advantage, but also invites scrutiny. Execution risk is high, but so is upside if network effects lock in. SoFi is not a stablecoin issuer, but it may be the best-positioned integrator. It owns a national bank charter, a full suite of financial products, and deep UX capabilities. That makes SoFi a potential bridge between stablecoin infrastructure and retail financial services. It can embed USDC in automated savings, digital lending, or cashback membership programs without issuing tokens. Its real opportunity is to own the user relationship while aggregating stablecoin utilities built by others. SoFi's financials are strong. In Q1 2025, revenue grew 33% to $771 million, adjusted EBITDA rose 46% to $210 million, net income hit $71 million, and member count grew to 10.9 million, up 34% year over year. 32% of new product sales came from existing users, evidence of robust cross-sell dynamics. Loan platform revenue rose 44% sequential and 100+% year over year, powered by third-party origination deals with Fortress and Blue Owl. Fee-based revenue now accounts for 41% of total sales and is on track to exceed 50%. This shift enhances margin durability and reduces rate exposure. The Genius Act gives SoFi a tailwind, legitimizing the digital asset rails it could plug into. But time is critical. If SoFi doesn't move quickly to integrate stablecoin wallets, cross-border rails, and DeFi gateways, it risks being left out of the transaction flow. With the right API partnerships, SoFi can become the stablecoin economy's consumer-facing command center. The real debate around the Genius Act isn't about technology or market readiness. It's political, focused on the fear that it opens the door to future government surveillance. Opponents in the House argue that unless the bill explicitly bans central bank digital currencies, it risks enabling state overreach. But the Genius Act is not a CBDC mandate. It creates a regulatory framework for privately issued stablecoins, digital dollars fully backed by U.S. cash or short-term treasuries. These stablecoins are issued by private companies, monitored by regulators, and operate independently from the Federal Reserve. The goal is transparency, trust, and safe innovation, not central control. CBDCs, on the contrary, would be digital dollars issued directly by the Federal Reserve. They are sovereign currencies, programmable by design. The government could potentially track, freeze, or restrict transactions. This is the core of the privacy and freedom concerns. On the surface, stablecoins and CBDCs both look like digital dollars, but their governance models are fundamentally different. Stablecoins are decentralized, private sector-driven, and regulated. CBDCs are centralized, state-issued, and fully controlled. Supporters of the Genius Act see it as a preemptive market alternative to CBDCs. By giving the private sector the legal clarity to issue safe, transparent stablecoins, it reduces the political and economic need for a government-run version. This is why firms like Circle, Coinbase, and Paxos back the bill. They want stablecoins to become the de facto standard before the Fed steps in. For platforms like Ethereum, this direction is ideal. Regulated, transparent, and privately issued stablecoins strengthen the on-chain economy without sacrificing decentralization. The Genius Act, if passed, would legitimize this hybrid model. For investors, the takeaway is simple. This is not just a tech bill, it's a policy firewall. The Genius Act could entrench private stablecoins and delay or even block CBDC rollout. That gives stablecoin issuers first-mover protection and could cement US-based firms as global infrastructure providers in digital money. The fight is less about what's built and more about who controls the next generation of dollars.